Years ago, when our local church was in the middle of a building and fundraising campaign, we met with the president of a large bank in the West. And he shared with us that 30 years ago, churches were the easiest institution for them to lend to. It was safe, it was easy, and it was really just a rubber stamp process. But through the economic downturn of 2008, 2009, banks learned that it's not an easy thing to have to foreclose on church buildings in a neighborhood. There's a lot of banks, especially large institutions, that went completely away from lending to churches. And you heard Pastor Glenn share as we started today that sometimes churches find themselves at a place where, by all measures, they should be qualified to borrow money, but just can't find a bank that's willing to work with them. And so today you're going to hear from multiple organizations that we partner with that specialize in funding and equipping churches to build and to move forward in what they're doing. So I want to introduce you guys Bill Dodson from Stifel as he shares with you guys their unique approach to equipping and lending to churches and building campaigns. Thanks, Bill.
Super, thank you. Okay. All right, so I want to take a couple of minutes to tell you, first of all, who we are. How many of you guys have ever heard the name Stifel? Yeah, I didn't think so. Stifel is actually a pretty big company. We are an investment bank. We have about 8,000 employees. Our stock is traded on the New York Stock Exchange. We have about $1.5 billion in capital that we can put to work in the market on any given day. We transact about $500 billion of bond transactions every year. We have 350 wealth management offices around the country, and we have about 50 public finance offices around the country. And that public finance division is what I'm a part of. So Stifel is, most of the investment banking that we do is what's called public finance, which means that we're financing projects for cities, counties, school districts, charter schools, private schools. And then I work in a very small practice area within the bank that does exclusively religion financing. So I've been doing this for about 22 years. I've seen a lot of projects. I've seen a lot of projects that never got off the ground. I've seen a lot of successful projects. The one thing I do want to ask you to do is get in touch with your lender, whether it's us or anybody else that you trust, as early in your thought process as possible. There's some very valuable information that your lender can provide you that will help it will help you start thinking about your project realistically. I cannot tell you how many churches, I had one call me yesterday, in fact, who they have a project that is they've already bought a piece of property, they've already started talking to construction firms, and the project is way, way, way out of their reach. It's just nowhere near what they could realistically expect to do. But they've got themselves in a situation where they're now going to be sitting on a piece of property for many, many years because they don't have the capital and can't access the capital to make a project happen. So talk to us early in the process and let us help you bring some reality to what you're hoping to do. All right. I have some brochures that I'm going to ask you if you want. They're sitting right over here, and there's a lot of information in there. But right now I want to talk to you about, oh, by the way, those are some churches we've worked with in the last couple of years, just a selected number. All projects, all different sizes, some construction, some refinance. There's all kinds of situations that we're asked to help with. All right, let's talk today about what I call the maturity matching principle. And the reason I want to talk to you about this is because this is where our analysis starts. As a lender specializing in church projects, this is where we're going to start. We're going to sit down with you. We're going to ask you about, where does the church want to be in 3 years, in 5 years, in 10 years, even in 20 years? We're going to talk to you about your project. We're going to try to understand as much as we possibly can about you. We're going to ask you for information, financial statements, obviously. We're going to ask you for information about governance at the church. That's very important. I don't know how other church lenders do it. I would imagine our friends at the Solomon Foundation are just like I am in that governance is very, very important. We're looking at the competency of the ministry leadership and how accountable they are and those kind of things as closely as we are the financial statements. But having said that, let's talk about this maturity matching principle. There's a principle in finance that says, in short, that the liability that finances an asset should have a maturity that matches the life of the asset. There's one variation on that. In some situations, you want the liability to match the cash flows that are associated with the asset. Today, we're talking about buildings. So, as an example, short-term debt. Let's say that you want to stock your bookstore at the church with Advent calendars, right? Well, that's really a short-term investment on the part of the church. You're not going to finance that, obviously, with a 5-year loan or a 10-year loan. You're going to use a credit card or maybe even cash, right? Because you're going to sell those things in a month, and you're going to have that cash back. Let's think about something a little longer term. Maybe you're going to replace some sound equipment or some AV equipment in your worship center. That you might finance with a 5-year loan. That equipment's going to depreciate pretty quickly. So you're not going to finance it again with a 5-year or 10-year or 25-year liability. The life of the equipment is just not that long. But today we're talking about something much different. We're talking about core assets of the church. If you look at the balance sheet of a church, the biggest asset in every church I've ever talked to is their building, their land and buildings. That's where all the capital is invested. So when you talk about financing a core asset that represents we're talking here about making buildings work for the ministry, right? So that building is super important to how you do ministry. It's a core asset. It's not easy to sell. And so when you invest in a building, you're investing for the long haul. If you were to look at an appraisal of a church building, a new church building is going to have a 30 to 50 year economic life. That's what the appraiser is going to say. So when you talk about the liability that finances that building, the loan that you're going to use to acquire or build that building, you really should be thinking in terms of something that matches the life of the building. So where are you going to go get a 25-year or a 30-year loan? Here's what happens when you sit down with most lenders, most commercial banks. And by the way, I'm not knocking commercial banks. I do a lot of business with commercial banks. A lot of our clients end up with loans from commercial banks. And I'll explain to you that process in a minute. But most commercial banks have to, because of the way they finance their business through deposits, they have to guard against interest rate changes that will erode the value of their balance sheet. So when they offer to make a loan to you, it's typically going to be a 5-year loan, maybe a 10-year loan. They'll put it on a 25-year amortization, but in 5 years, you're going to have a balloon payment due, maybe in 10 years. That balloon payment exposes the church to a couple of risks. One risk that's a big risk, actually, and especially in this environment, is interest rate risk. Interest rate risk is the risk that interest rates are going to go up 5 years from now, and the church is going to wind up paying a lot more for that loan than they were when they originated it. The other risk is access to credit. Someone mentioned a minute ago what happened during the financial crisis of 08 and 09. For the first time in my career, I had to work on some church foreclosures. That was not fun. Some of those churches could potentially have gotten out of that trouble if another lender had been willing to lend them money. So when a loan matures with a balance due, what's happening is that the church is exposed to the risk of not having access to credit. So we kind of talk about borrowers in two categories. The hedge borrower is the borrower who finances, they create a hedge against interest rates, against access to credit and other risks, and they do that by matching the liability that finances the asset, right? They match the maturity of the liability to the life of the asset. It eliminates those risks. The speculative borrower is the borrower who is saying, by the way they structure their debt, that they're willing to take some risks. They're speculating on what interest rates are going to be 5 years from now. They're speculating on whether their bank is going to be willing to renew the loan. So, two kinds of borrowers. The speculative borrower is exemplified by, again, let's go back to the 2009 crisis. There were people who borrowed money to buy real estate who had no way of ever paying back that loan without selling the asset that they used that loan to finance. So they went out and bought houses, expecting that they would be able to flip those, sell them for more than they owed the bank. And for a lot of those people, it didn't work out that way. So that's an extreme example of what we call a speculative borrower. And what we say to churches is, if you're going to speculate, be sure that you understand what your church's tolerance for risk is. Okay, so that's one of the things we would sit with you and talk about if you came to meet with us. So a mismatched or a speculative credit would have a short-term maturity. It might include rate resetting provisions. Sometimes banks will offer you a 10-year maturity, but they want the loan interest rate to reset after 5 years. So that exposes you to that risk, even though the loan's not maturing. It'll have balloon payments, might include interest rate prepayment penalties. Some of the more difficult situations I've seen churches get into involve what are called interest rate swaps, which is a completely separate agreement from your loan that overlays the loan, and there are some risks involved that most churches can't really comprehend. Ongoing financial performance covenants, right? Those can expose you to risk. If you don't meet a ratio at the end of the year that the bank wants you to meet, technically they can put you into default. On the other side is the hedge borrower. If you're building a building with, how much time do I have? I don't think I'm over yet, right? Okay. If you're building a building with a 30, 50-year economic life, get yourself a loan with a 25-year maturity, right? No balloon payments, no interest rate changes. So you eliminate the renewal risk, you eliminate the interest rate penalties, the interest rate risk, and you can eliminate a lot of the financial performance covenants depending on the financing that you obtain. Okay, how do you get that 25-year, 30-year fixed rate financing? For the most part, it's not the only way, but for the most part, what that means is the church has to issue bonds. Bond underwriting is our specialty. It's what we do. We do it every single day. We're closing dozens of bond underwriting transactions. Some of those are churches. When we offer to underwrite a bond issue for the church, what we're offering to do is to put our capital to work. I know over the years, especially for some of you guys who have been around a while, your expectation about issuing bonds is that somebody's going to come in and hawk bonds to your church members to finance the project. That's not how this works. Stifel, I told you, Stifel has $1.5 billion we can put to work in the market. When we sign that underwriting agreement, what we're saying is that we're going to buy those bonds from the church with our capital And then those 2,500 financial advisors that work for us are going to sell those bonds to their clients. So you don't have to, you won't even know who the bondholders are. Okay? So all you have to focus on is what are the terms and conditions of the financing that you're getting. And what you would be getting is 25 to 30 years, fully amortized, fixed rate financing, no ongoing financial performance covenants, no prepayment penalties. It's in the military. My son's a Marine, and he tells me they have what are called fire and forget weapons. You can pull the trigger and literally turn your back and walk away, and that weapon goes where it's supposed to go. Bond financing is fire and forget financing. You pull the trigger, you never have to refinance it, you never have to renew it. It's out there until it's the commercial equivalent of a 30-year home mortgage, basically. So please bring us in as early in the process as you can. We'll sit down with you, analyze your financial statements. Almost certainly you're going to end up having to talk to somebody like Chris and raise some capital, right? Put some equity in your capital stack. But then we'll also talk to you about how to close that gap with financing, help you put some realistic expectations around the size and cost of your project. We love working with BGW, by the way. I've financed a lot of BGW projects. And when you hear people say that it's a great group and that they know what they're doing, it's true. It really is.